Hey guys, Aaron from EK Financial Group here. I'm going to show you a powerful presentation in relation to investment bonds. You also might know these by the word growth bond or insurance bonds. They're potentially for clients that are looking for some sort of long-term investment and can help with tax concessions. So there's four main reasons why a client would consider an investment bond, and I'm going to explain these in this presentation. Hope you enjoy. Please give me some feedback and let me know what your thoughts are. Thanks, guys. So let's get into this presentation about investment bonds. The what, the why, and the how-to by EK Financial Group. So my very talented associate team put this together for me. So I can't take all the credit. Let's get into it. So the four main reasons why someone may be interested in investing or putting money in an investment bond. Number one is if maybe you're a high income earner. As we know, if you earn over 180 grand a year, you are paying the highest marginal tax rate. That's 47%, including Medicare levy. An investment bond can help because it pays a maximum tax of 30% inside the bond. Maybe you're concerned about your family contesting a will. So if you knew, not sure if you did, but 86% of contested wills end up going to court. If you want to leave something special like money or investments to someone, but don't want others to contest or even find out, then investment bond can help facilitate this process. By the way, also, this can be done with no tax implications for the recipient of this money or investment at the end. So is your family trust distributing income when you don't want it to? So if you've got a large family trust, rules are that obviously all trust income has to be distributed. Otherwise, you may have to pay the highest marginal tax rate on the income. So investing through an investment bond, there is no reportable income to the trust. This means that even in a trust, you can let your investment compound over time without having to make distributions annually out to the trustees or beneficiaries. And the fourth thing, and probably most common that we use it for, is saving for your kids or grandkids' future. So investment earnings for minors can be taxed up to 45%, depending on how structures are put in place. But if you want to invest for a minor, say for your children's education or maybe a house deposit to help them in the future, and you want to gift to them at a certain age, an investment bond has a maximum tax rate of 30% even for minors. So that's a very good way of investing for your kids' future as well. There is a catch. Sounds like sunshine and rainbows, but let's have a look at the different rules. There's two significant rules you got to pay attention to with the investment bond. The 125% rule, which is on the contributions, and the 10-year rule, which is a rule around the tax implications on withdrawals. So let's firstly look at the 10-year rule, so on withdrawals. So this affects withdrawals. So if you withdraw within the first 8 years, then you have to pay tax on the assessable portion of income that the growth bond or investment bond has made above the 30% tax rate, based on your marginal tax. Now, if you withdraw after year 8, and between year 8 and 9, then 2/3 of the assessable portion will be taxed. After year 9, it's only 1/3. And then after year 10, there's zero tax to pay or further tax to pay personally for yourself. 125% year contribution rule. So each year you can contribute only 125% of the amount of contributions you made in the prior year. Otherwise, the 10-year rule resets. So what I tell clients is you can put more in, but it just resets the 10-year rule. So if you've got a young kid that's 1 or 2 or 3 years of age and you're happy to let this run until they're 18 or in their 20s, then if you reset the rule, the 10-year rule in the first few years of the child's life, probably not a big deal. But if they're 15 and you want to give them the money on their 18th birthday, you don't want to be resetting that rule. Okay, so here's an example. So if you contribute $10,000 in year 1, the maximum contribution in year 2 is $12,500, which is 125% of 10,000. If you didn't make a contribution last year at all, you had the fund running, you just didn't put any money in, well, the maximum contribution this year is zero, because $0 times 125% is zero. However, what I tell my clients is if you want to continue that because it's such a great structure, we can always set up a second or a third growth bond. Okay. Estate planning. So what are the benefits of estate planning? So an investment bond is a living will. So if you want to change something in your will, fantastic. You don't need to redraft your entire will. And obviously to help pay your solicitor to go to the Bahamas or go on their holidays. How do we do this? So investment bonds don't form part of your estate. So a lot of people wouldn't know this, but when someone writes a will, they can only direct certain assets to be distributed. For example, your will does not necessarily direct where your superannuation goes. That's why you do a beneficiary in your super fund. Another example is if you live in a house and the title is in joint tenants, like you and your partner or spouse, then your will can't direct where the property goes. It just goes via the joint tenants directing. All investment bond is one of those assets, and that a will does not necessarily direct. Okay. Why is it important? So really, a will can be challenged, and 86% of these challenges do end up in court. The silver lining is if the will can't direct where an investment bond goes, then a challenge to a will cannot overturn your wishes. So how would you feel if you wanted all of your share portfolio to go to, say, your nephew Johnny, but your two children, maybe you don't have a relationship with, who you don't want to leave anything to, contest it, managing to overturn your will against your wishes, and poor Johnny is left with nothing? A growth bond can help facilitate this process. So what else can it do? What else investment bonds can do? So they can do more than just determine who gets it. One thing, tax-free. So normally, if you leave someone your investment portfolio in your will, they would have to pay tax when they sell those assets. Okay, it's not the case with an investment bond. They don't have to pay tax when it's sold. Decide who gets it and when. You can decide if you want your beneficiary to receive the investment bond at, say, 25 years of age, maybe after they complete university, so you can actually put those nominations in. You can limit what they do with it as well. So you can actually decide if you want them to only take the income from the investment bond each year, or maybe they're able to sell it all and take all the proceeds as they wish. So in summary, so if there's going to be will contested, no worries. Challenges to wills won't affect your wishes for your investment bond. Tax-free inheritance, beneficiaries won't pay tax when they withdraw the funds. And you can map out the terms of use. So, you know, what the beneficiaries, you want them to wait to 25 years of age, that's sorted, you can do it. Or if you only want them to take out 10,000 a year, then got you covered as well. So that's a summary of estate planning and why it's beneficial. Now let's look at the tax side of things. So equally as useful as a living, for the living, how will investment bond benefit me and my wealth accumulation? So let's have a look. So investment bond on the left-hand side, traditional investment on the other. On the right, let's have a look at the investment income. So in investment bond, it's taxed at a maximum 30%, where in a traditional investment platform, where it'd be shares or managed funds, it's taxed at a maximum of 47%, which is maximum marginal tax rate. Withdrawals, assessable component eligible for 30% tax offset, and eligible for capital gains discount after 12 months period, okay, on a traditional. And after 10 years, tax-free on all withdrawals, and after 10 years for an traditional investment, you still have to pay capital gains tax. Now let's look at this tax rule in a bit more detail on withdrawals. So as I mentioned, there's 1/3 of all assessable income from the withdrawals are exempt from income tax after 8 years. After 9 years, it's 2/3 exempt. And after 10 years, it's all withdrawals are exempt from income tax. So that's why we traditionally recommend these for our clients with young children if they want to invest for their children's future, and it's a long-term horizon, 10 plus years, then this may be appropriate for their situation. So here's a bit of a screenshot on withdrawals. So here's the first 10 years. Okay, the gray columns there, the dark gray, meaning that you will be paying tax on those withdrawals, but you get a 30% tax offset benefit applies to any taxable withdrawals, okay, in that whole period. Then in year 9 and 10, you do get it reduced. There's only 1/3 tax-free and 2/3 tax-free. But then from year 11 years onward or 10 years onwards, there's no personal tax payable on bond earnings at all, okay, and that's based on withdrawals when you take the money out. So what about kids? What's the benefit with an investment bond for children? So some reasons why you might want to invest for your kids long-term or an investment bond is around their education costs, to accumulate wealth in general, maybe for a wedding, a gift for a special occasion, a holiday, maybe paying for a house deposit. So time is your friend with an investment bond, because often when saving for your children, time is your friend. In many cases, you can take advantage of this 10-year rule when you're saving for your kids because it is a long-term investment. Withdrawal the investment after 10 years, say for your child's 18th birthday, and it will be completely tax-free. On the withdrawal, compounding is obviously a very good friend to any investor. So investing over the long term, you want the power of compounding to work for you. So this is going to do a lot more for you if you just let it do its thing, let it do its job. And paying up to 45% tax on investment earnings over 10 years adds up. So if you're consistently paying that because you don't have an investment bond structure, wouldn't you just prefer to pay a maximum of 30% in the bond? Good thing about the bond as well is that you don't declare this on your own tax return because the bond itself pays 30% tax through the fund. So you don't have to even talk to your accountant about it or put it on your tax returns. Trust structures, so why they a good reason. So investment bond income remains in the bond. So this means that if you hold the bond inside a trust, so that trust will not have to have any trust income, which will be normally have to be distributed from beneficiaries based on this money in the investment bond. So it's at a 30% tax rate. So investment bond can take the place of the trust bucket company without all the cost of setting up and running a company structure yourself. Okay, so there's no setup or no ongoing tax returns required for investment bond, which is a benefit versus setting up another trust or company. You're not reported on beneficiaries' tax returns. So we've covered this already. Investment income does not go on your tax return at all. And you're not paying up to 45% tax on investment income. Allows your money to work harder and not reported on trust tax returns either. So simply your trust tax return, simplify your trust tax return. Sorry, if you've got property, shares, all this in a trust, then you can simplify those returns as well by having money or some of that trust assets put into investment bond, because then you don't need to do a tax return on that investment bond assets, okay, which will form part of your trust. So another benefit there, which is awesome. We see a lot of use for. So then the main benefits I wanted to talk about. Obviously, if you want further advice, please reach out. Here's our contact details. It's very important that you do get advice on this yourself personally based on your circumstances, based on your trust arrangements, your kids' structures, and those type of things. So please reach out if you want some more help or advice. Let me know. And I hope you enjoyed this presentation on investment bonds. Thank you.